Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. We're here at the Forex Expo in Dubai, but I'm joined by our market analyst here in Dubai. That is Mohanad, and great to see you. Of course, really busy event here today, and it gives us the opportunity to talk about everything. I mean, this is a great topic because I wanted to talk to you about the end of the year, right? So for a lot of the time, people talk about markets, don't necessarily talk about what they expect, what's to come. They're always looking backwards. We can look backwards at the beginning, but let's look at kind of what the current makeup is of the market. How do you see things right now? What do you think is going to sort of shape up at the back end of the year? So I guess looking at the current market environment, how do you see things right now? How do you see things? Of course, equity markets, record highs. You've got the likes of US dollar continuing to fall. You've got gold at record highs. Rates being cut. Good environment, something to be fearful of. How do you feel right now?
Thank you, Josh, for having me. And basically, markets right now is buying everything. Everything is just on the rise. When it comes to the US stocks or even the global stocks, we're talking about gold also all-time highs. So we can see that the strategy right now in the market is buy everything, right? So we basically have a lot of things on both sides of the spectrum, whether on the positive sentiment or even on the negative sentiment. So when we look on the US stock markets, yeah, earnings are good. The stock market is doing great. The companies are posting good earnings. However, on the other side of the spectrum, we still have the US government shutdown, and we don't know how long this can go on. So yeah, I can say that there is optimism in the markets, but maybe with caution. So people are buying in the stocks for the long term, but on the short term, maybe we do have some couple of things that could add risk to the trading environment. So yeah, markets, I would say it's good at the moment, but let's see how things can fold in the next couple of months.
It's interesting, actually. You talk about the government shutdown. I think it's kind of like a perfect example. It's like a stress test of market sentiment.
Exactly. Yeah.
If markets were particularly fearful right now and on the edge of rolling over, many people say the fact that gold's doing so well is indication of the fear within the markets, right?
Exactly.
If they were that fearful, they'd probably sell markets a little bit more than they have done. Right? It felt like it's like a one-day affair, and suddenly you see equity markets just rising once again. Exactly. Anytime there's a little bit of a blip, a bit of a dip, you could just buy into it, which really sets us up for a Q4 that really, I mean, we're expecting to see rate cuts really dominating from the Federal Reserve. We're in a position to do so. Inflation relatively stable where's the stand. Of course, the jobs market, despite the lack of data because it's shut down, jobs market isn't in a perfect condition. See the ADP payrolls figure coming in weak once again for the just gone. Yeah. And so it really sets us up for a phase where you've got, of course, some expectations and hope for the US economy to strengthen once we see some of these trade deals coming into fruition and actually boosting the US economy. But then alongside that, we also have the actions of the Federal Reserve, where by and large, historically, you might see rate cuts coming into play when you see major economic weakness. Of course, the jobs market, we are seeing a bit of that, but not necessarily major economic weakness. I don't think people are expecting a massive collapse in terms of the US economy. Santa rally, is it too early to start talking about that? Should we instead focus on October? Should we start talking about November as being the month to follow? I don't know. How do you feel? Do you think people waiting for that Santa rally are just going to miss out on more gains in the meanwhile?
Okay, I think statistically, when we look at the fourth quarter performance in the US equity markets, it's basically the best performing quarter in all of the years. That's, historically. So not only the Santa rally is supposed to push markets higher, but people generally are optimistic in the fourth quarter of the year with lighter trading conditions and, rebalancing of and the reallocation of assets by the big firms. But if we specifically mention Santa rally, which is probably the last trading week in December and the first couple of trading weeks in January, or a couple of trading days, I would say that, historically, the S&P 500 has gone up like 1.3% in this period because it has many, many factors that could influence the Santa rally. If you have those ingredients in the market, if people are optimistic about the new year, then we could see the Santa rally happening this year. Probably the main thing supporting the US indices at the moment is the interest rate cuts expected by the Federal Reserve. We're expecting 1 to 2 interest rate cuts this year. So if the Federal Reserve delivers those rate cuts, of course, we can see more weakness on the US dollar side that could boost the equities side. So, one of the ingredients is there, which is the federal policy easing. The other thing is the earnings for the fourth quarter. Expectations are that we can see earnings right up with 7% during the fourth quarter. If this basically materializes, it could be another ingredient for the Santa rally. So historically, and seasonality is only a tailwind to all of the other factors. But if you have those things on sides, the fundamentals along with the technicals, we could see markets just celebrating the new year with another push in the U.S. equities.
Yeah, and I mean, what's interesting, we're talking about the fourth quarter generally being the best quarter of the lot. That is true, but generally the best month lot is November, right? So December is supposed to be good. Like I said, October, November, 75% of the times over the past 20 years would have seen it in the green. And so, I personally think you're looking towards the back end of the year. So right now we're focusing on the rate cuts ahead of us and expecting we're going to get one at the end of October, one in December. The question marks aren't necessarily for the rate cuts of this year. They're for the rate cuts of next year. Part of that comes down to the uncertainty that's going to be inherent within the fact that we don't know if inflation would have risen by then. We know what the inflation rate is right now. So it gives us some clarity over what's happening over the near term, not so much for next year. I guess it sort of brings around the question mark about exactly what Federal Reserve is going to look like next year. But at the mid part of next year, we might have, most likely someone else at the helm at the Federal Reserve. And so the one rate cut currently laid out under the dot plot by the Federal Reserve might look very different from reality. It's only markets pricing that 2 to 3 rate cuts for next year currently being priced by markets. First, like I said, one for the dot plot. I guess one of the big stories at the moment is about valuations within markets, right? Because everyone's saying, if you look from a historical perspective, the price to earnings ratio associated with, let's say, the NASDAQ, particularly lofty, but yes, you do 500 as well. I guess there's the question mark about whether those valuations are justified because of the incredible growth rates that we're seeing, particularly within the tech sector. Is that something that you're particularly worried about? Are you thinking, well, we can't keep going up because valuations and multiples are already so high, or do you just think it's justified?
I think markets are okay to expect more earnings. The valuations, they are high at the moment. But when you look at specifically at the tech sectors, a stock like NVIDIA has been beating expectations for the past how many quarters? I mean, valuations are higher, but the earnings are coming also stronger to back those valuations up. So at the moment, no one knows how far those valuations can go higher. And as long as the earnings support this high valuations, I think we can see a continued, optimism in the U.S. equities valuations and specifically with the tech sector. One thing you mentioned about the next year and the Federal Reserve expectations is we don't know what the Federal Reserve policy will be about or how will it look like in the next year, 2026. And my concern right now is regarding the U.S. government shutdown, because we are not having data for the last 1 week. And we don't know how long this can continue. If the Federal Reserve is following the wait and see approach, which is wait for economic data to come out so we can assess and monitor those and then take a decision, we don't even have economic data out for the last 1 week. So I think if the US government shutdown continues for a bit longer, things can get so complicated for the Federal Reserve because, the last inflation data and the last data from the labor market was already complicated enough for the Federal Reserve, and now you don't even have to see those, or you don't even get to see those new data incoming. So I think, things so far in the markets are stable, but heading into 2026, things can get really choppy if the economic data stream is not updated well enough.
I think that's interesting, actually, right? So at the back end of this month, that's when we're going to see the Federal Reserve coming out with their rate decision. And ultimately, there is a perception that, yes, we've got the shutdown at the moment, but by and large, we've got enough time for them to resolve that. And then we get the data, and then they should see the jobs data before this decision from the Federal Reserve. Perhaps it's the case that if we get closer to that and the shutdown just keeps rolling on and on and on, and if the Fed actually lay out that they might take different decisions if they don't have data, it kind of puts a bit more pressure on the situation. But right now, because of the gap between when the shutdown started and when the rate decision is, there is a perception that they'll come to an agreement soon enough, and it won't really make that much of a difference. People won't have them backdated, and we're all back to normal. I guess there's been a story, of course, this year in terms of like US exceptionalism, moving money abroad. That's relevant now that we're here in Dubai. Many people moving their money into equities, whether it's least or Chinese indices doing particularly well, the likes of the DAX hitting record highs, the FTSE 100 keeping local highs. Do you think that Wasn't the fear that really started when Donald Trump came into power and all talk around tariffs and breakdown in terms of trade relations? Do you think aspect was done now? Or do you think that the sort of diversification from geographical perspective that was kicked off then is going to stick around for a while and people have kind of broadened their mind a little bit as himself?
I think the US markets are just there to continue moving higher, right? At the end of the day, with all of the uncertainties that we are talking about today in the US economy, with the weak data, you have high inflation and you have a weakening labor market, and you look at the stock markets, they are still moving higher alongside the safe haven, which is good. So this is really, I wouldn't say confusing, but this shows that, okay, even if there are fears in the global economy, whether from geopolitical tensions or from trade tariffs or whatever you can, it's still moving higher, right? People still believe that whatever is happening at the moment, it's still on the short term, and equities will still continue moving higher on the longer term. And this is why even when you get a new high, it's only a short correction before you have a new higher high. So this is, the current situation in markets. Valuations continue to move higher. Earnings support this, good valuations and expectations for the U.S. market. So this is, the fact on the market at the moment.
Yeah, I mean, it's an interesting one. I had the TV interview the other day and they wanted to talk to me about IPOs in the UK, namely because the UK's dropped out of the top 20 IPO markets by the value of those IPOs were. And I was trying to think of it, like top 20, that's a significant number. Why is that happening? And in actual fact, part of it comes down to if you're going to have an IPO that for a company that's based in the Middle East, you're probably going to list in Dubai, right? If you're going to do it in, I don't know, Hispanic-speaking country, you might list it in that country. Within the English-speaking world, everything pretty much goes to the US. And the US companies are so globally focused, they have such huge growth, that the idea that people are just suddenly going to start moving all of their money into all of these geographic and regions, it's not be that realistically, but always very attracted to the sort of deep liquidity within the US markets and the access that you get, and trading platforms very heavily focused towards US stocks in particular. So yeah, I mean, I don't think it's going away anytime soon. And ultimately, we've really been through a period when many of these other countries have really seen their rate cuts, like say the ECB, they've done much of the heavy lifting on the easing. So now it's almost like, US markets near record highs, but they've also still got quite a lot of easing ahead of it. So there's quite a lot of optimism to bake into that. I guess if we're looking in terms of the US, you've got to talk briefly about the US dollar. Of course, it just continues to fall. It has stabilized a little bit more recently. Notably, if you looked at the last time Donald Trump came into power, it was like the first year and we saw major downside in terms of the US dollar, and then it stabilized and started to regain ground. So, I wonder if you think it's going to be a similar kind of thing this time around. I think personally, I find it harder to call the FX markets than I do the likes of, say, indices or gold. We see much more long-lasting trends over historical timeframes versus FX, where it's, two currencies butting heads. But I do think, when you're looking even at the equity story, that the attractiveness of US equities is less so when you're seeing a major devaluation of the US dollar, because certainly for people in the UK, if you have an ETF following the S&P 500, for example, and then the US dollar is constantly losing value, then all of the gains you would have made the S&P 500 are relegated because of FX considerations. So certainly the direction of travel for the US dollar is going to be really key. So do you think it's probably going to be further downside from here for the greenback?
I think as long as markets expect further easing from the Federal Reserve during this year and 2026, as you said, markets are pricing 2 to 3 rate cuts in the next year, although the dot plot only shows one. So markets are really optimistic that the Federal Reserve will continue the easing policy. And in this case, we can just expect the dollar index to continue moving lower unless the inflation proves to be more sticky than expected. We are talking about inflation numbers that's much higher than the Federal Reserve target, above 2.7%, and as per the last reading. So what if the inflation is more sticky than expected? I think the Federal Reserve might stop the easing cycle or put a pause on the federal rate cuts to try to get inflation back under control again. And in this scenario, I think we can see the stabilization phase or the consolidation phase on the dollar index. But I don't really see an upside potential for the dollar. It's either moving lower or just consolidating for the time being.
Yeah, no, I think you're probably right. And a lot of it comes down to sort of relative yields associated with the two, which a largely driven certainly on the short end of the curve by what's happening in terms of, say, the Federal Reserve versus the ECB and things like that. And so you might see some blips, but certainly if you see the direction of travel for the Fed as continuing to be down, and you see these other central banks have already sort of done their business, then really it does point towards, unless we see a major uptick in inflation, exactly as you said, that's point towards potential further downside. Earnings coming out within the space of like, I think a week or so.
Yeah.
It's not necessarily the big hitters. Generally, we sort of look at banking sector as being the proper start of it. We have got a couple of names sort of leaking through at the beginning. That always is an interesting time because markets really sort of shift focus in terms of exactly what they're focusing on. Do they care about just earnings? Do they care about what's happening in terms of monetary policy? It feels like monetary policy is quite clearly defined at the moment. So earnings season comes into play. Big story about are these valuations right? As we were talking about earlier. Big tech, is their valuations justified? Now, what are you looking out for within this earnings season?
I'm looking for the market expectations for what's coming after this market earnings report. So let's say the companies come out and say, okay, we're doing good business, we're having good earnings for the third quarter. But what are the expectations for what's coming heading into the 2026 expectations, whether we can see higher earnings to be reported in the following quarters or not? This is somehow what will matter with markets, or this will affect markets somehow on how the expectations into the 2026. So I'm interested to know how things will be looking into, going into 2026. And of course, I believe that the earnings season itself will again post some good gains on especially in the tech sector. But what will matter with me is what's going into 2026. Can we sustain those high expectations and high valuations for 2026, and especially the fourth quarter this year, or not? This is basically what I believe will control the valuations in the next periods.
Yeah, I mean, that's definitely right. I mean, ultimately, if we're looking in terms of the outlook for earnings, a lot of the time we focus on like, did they beat or did they underperform? Now, generally, because of the fact that markets are priced quite highly when we look at the valuation metrics, if they underperform and they miss, you see much more significant downside in terms of the share price than the gains you see if they outperform the first estimates.
Yeah.
I think the interesting thing this time around, like, is for those companies, I mean, the tech sector is definitely going to be interesting, but for those companies just within the economy, tech for much of it, sort of their clients are other tech companies. Many of these other businesses have to straddle. On one side, we want to know, are you benefiting from AI? Is that going to improve your margins? The other side of it is, are tariffs hitting you and is that going to hurt your margins? So it's sort of the two sides of it are going to be key to look out for. And as you said, like the time, whether you beat or whether you miss, we could beat both at top and bottom line. And ultimately, if we come out with a comment that says you're not that optimistic for the year ahead,
Exactly.
the stock will drop, right?
Yeah.
I guess we'll wrap it up. I think we're towards the end, but I just wanted to talk to you briefly about the risks, right? Because of course, when equity markets are going up, everyone, this is great. Every time it pulls back, just keep buying. Same kind of thing, I guess, with gold. But sometimes when you lull yourself into a false sense of security about the direction and strength of a trend, you don't necessarily pay too much attention to the risks. So what would you say are the sort of main risks at the moment that are trading?
I think the main risk for me in the equity markets at the moment are the inflation numbers, because as we said, if the Federal Reserve wants to keep on cutting interest rates this year and heading into 2026, what if the inflation saw an uptick during the next period due to tariffs, due to geopolitical tensions, or just the inflation proves to be more sticky than expected? I think that this would be a major risk for the equity markets, because if the Federal Reserve starts deciding that, okay, maybe we could also focus on the other side of the equation, which is inflation, not only the labor market, we can see the stock markets being hit dramatically during the next period. And another risk for equity markets is that if the labor market proves to be not so bad as the Federal Reserve has seen or noticed during the last period. So if the labor market shows some minor resilience with an uptick in the inflation numbers, I think this is a combination of a really, really bad situation or a risk scenario for the equity markets. Whether it happens or not happens, it all depends on the data. So we will wait and see for the inflation data coming in the next few months.
Yeah, I mean, definitely, I would say inflation's the big risk. Because suddenly it just completely turns the whole dynamic on its head. The one thing I'd add to that, I guess, is tariffs, it sort of feels like it's all behind us because deals have been struck left, right, and center. But I don't necessarily think that it's completely inked, right? So the idea that, we're going to buy $500 billion worth of X, Y, and Z, that a lot of those are sort of agreements. And if that is sort of reversed course, if they go back on that or they're not buying them as agreed, then suddenly you have to redo that. There's also the US-China issue, and the US are talking about them to bail out the agricultural sector because the Chinese basically not buying any soybean. So a deal needs to be reached or else they see a breakdown in terms of some parts of the US economy. Clearly, the Chinese are trying to show their strength by sort of putting pressure on different parts of the US economy. If you see a trade deal between the two, brilliant. If you don't, then that could start to raise issues around tariffs that could also emerge in areas that potential deals have already been reached.
Yes.
That's it for today's podcast. Make sure to join us for plenty more commentary like this. We've got another one very soon at ASL. Havel, CEO of Scope Markets, talking about all things AI. For this one, my name is Josh Mahony, Chief Market Analyst. Thanks a lot for joining us. And Mohanad, thanks for joining me.
Thank you. Thank you so much.